Hey, it's Dr. Ryan, and I'm here for part 2, Annual Worth Analysis for Engineering Economics. Still part of Module 9. We're talking about annual equivalencies. So, let's talk about them. So, most of the time when you're looking at this from a business perspective, you're going to have to do some other calculations. And you're going to have some associated costs, but you might be producing something. So, in those situations, you're going to have to look at, if you're producing units, okay, how many units are you producing on an annual basis? Because look, we're looking at annualized equivalencies. So annual basis is really the key here. Look at the cash flow. There might also be some other associated costs like power, those other things. Remember, one of the very first principles, though, of engineering economics, costs that are the same between two different things that are being considered, are discount. You don't look at them. You don't bother with them. You look at the things that are different. So just remember that when you're doing a comparative analysis of two different things. Anyway, if you're looking at something like a unit cost, you want to know what that cost truly is on a per unit basis. Same concept. You get your cash flow, you look at what you're producing, you get an equivalent annual worth, you just divide by the number of units produced. It's that simple. Now, we're going to do an example, but we're going to look at it a little bit different. First thing I'm going to do is just say, hey, we're going to do an equivalent worth per unit time. I don't have the per unit time in yet. Here's what we're produced. Here's what we got. We put 75,000 in. We got these 3 outflows at year 1, 2, and 3. Those are costs. I didn't go into the details of where those costs came from. That could have been operating cost. It could have been power cost. It could have been other things. Okay. And that's subtracted from what you're actually getting out of whatever you put the money into. So let's say we bought a piece of equipment, 75 grand up front. This is what we're getting. This is the net annual. Now, we're going to take that. That's pretty straightforward. We can calculate the annual equivalent. Get the present worth, A over P. We're using 15% here. 3 years. Okay, pretty straightforward. 8093.05. You should be able to do that calculation. A over P. It's not a fancy trick calculation, and figuring out the present worth of 3 different things at 3 different points in time. Actually 4, because you got 1 at time 0. Again, it shouldn't be that hard for you. Now, we've got this as an annualized equivalent. So now let's look at what other basis we can look at these costs on, other than just annual. I just said we've got the concept of a unit cost. If you're producing units of something and you produce X number of units per year, basically you can just take 8093 and divide by the number of units, and you got per unit. What's another way that we look at this? Well, one is we look at it in terms of hourly operating costs. Suppose it's a piece of equipment. So like in this case, let's say the equipment operates for 2,000 hours per year. Well, in that case, we just simply divide by time. And now we can get an hourly cost, hourly operating. And actually, it's not, this is what we're actually making, because this is a positive cash flow. So it's really, it's a negative cost. It's a positive worth. Okay, keep track of your signs. Money coming in, money going out. Okay, but we're making $4.05 an hour on the operation of this equipment. That's if we divide by the amount of time that we operate the equipment. Or we could look at on a per unit basis if we're producing units of something. I'm not going to go over all the different scenarios because they are pretty much infinite. But the most common you're going to see is per unit produced and per hour of operation. Those are kind of the ones that you're going to deal with. So you should be able to do both of those. Unit analysis, okay, engineers here, unit analysis, the units have to work out, okay, should get you to the answer pretty easily. If you want to know what it costs per hour, it should be dollars over hours when you work out the units. That simple. Now, what if we want to say, you know what? Should we make something or should we buy something? Well, there's a few things when you're looking at these decisions, and these are things to consider. Okay. How long? How long are you, how long do you need these parts? Because you're either going to make the part or buy the part. And how many are you going to need? How much is it going to cost to buy it? These are all pretty much obvious. Okay. Now, the equipment, the manpower, what all do you need to make this thing? Okay, because buying it, you probably don't need that much manpower. Maybe you need somebody to go pick it up. Put all those net cash flows in there. Then you look at the equivalent cost of producing the part. And you look at the equivalent cost of making the part. Okay, I'm sorry, buying the part, which is pretty straightforward too, because it's just how many you need per year. And you pick the best one. That is a very common decision. But nothing in this list should be like, oh my gosh, where did that come from? It's an annual equivalent cost. You need parts, you're going to make them or you're going to buy them. It's going to cost to buy them. It's going to cost to make them. You put those costs in an annual equivalency, and voila, you've got it done. Now, of course, there's other factors to consider when you're purchasing parts. You do know what you're getting when you make something, and you hopefully can make something of decent quality. It's also an issue to consider whether, when you're buying it, whether the parts you make are going to be of the quality that you want them to be. Alternatives. Again, looking at this list should not befuddle you. How many do you need? How much is it going to cost to make them? How much is it going to cost to buy them? Put in terms of an annual equivalent cost, compare. That simple. Okay. Hardest thing it might be is estimating some of those specific costs. Equipment, manpower, power, roof space, all that stuff. Those are costs. So let's look at ones that have, like here's an example. 2 motors, 25 horsepower motors. Basic motor costs you 13 grand. The premium motor costs you 25 or 15,600. They're both 25 horsepower. They both last 20 years. They both have 0 salvage. One's more efficient than the other. Power costs the same. Operate them the same number of hours. Okay. Well, one's more expensive up front, but it's more efficient. Okay, what do? You need to go ahead and figure out an annualized cost for these things. But remember, it's 20 years time span. You can't just say, 15,600 times with 0.93 times 0.07 because it changes over time. So you figure out how much power those need. Efficiency is what plays into the power. You should be able to do a power up equation for motors. Okay, you know what you got to put in, and you figure out how much is that power going to cost you. Okay, 0.07 cents per kilowatt hour. If you find some power for 0.07 per kilowatt hour, let me know, because I'm going to buy it because I can sell it for more. Right now it's a little bit more expensive than that, but hey, that was the number I had when doing the calculations here. Power costs money. Sorry. Okay. So both of these motors are going to cost a different amount to operate every year. Now, reality is that annual energy cost is probably going to change over time. So you're probably going to have to look at that on a time basis, year after year after year after year. It may even be a gradient. Doesn't matter. You can still do this. Okay, this one's a simplified version. We're assuming it's 0.07 dollars per kilowatt hour. You can calculate this. Again, this should not befuddle any of you. This is very straightforward. This is the cost of energy. You're engineers, you can do this. So we've got capitalized cost. Okay, you know what it's going to cost, but we need this on an annualized basis. Straightforward. Okay, 13% interest, 20 years, A over P. There's your annual capital cost. Remember, we wanted an annualized basis. Now we're going to have to actually look at the specific cost. In this case, we looked at cost per kilowatt hour generated for each of the two motors. Not that much different, because the only real difference was the efficiencies of the two motors. Okay, but you now take into account the actual capital cost up front. So we now have an annualized equivalent cost of those, cost of operating, plus the capital cost, and an annualized basis. See, now we can add them together. Cost for operation plus the annualized cost. We now got on a kilowatt hour basis. Notice that conventional motor, it's actually, because the efficiencies didn't make that big of a difference, okay, really not that big of a difference there. So at some point, you're going to see a break-even point of the two. Because remember, the premium motor costs you more up front, so you can actually look at it on a year-by-year basis or an hour-by-hour basis. But in the operating cost, okay, you're looking at those operating costs. One's more efficient, so it has a lower operating cost. So the upfront cost for the premium is higher, but its operating is lower. And eventually they'll cross each other. These two are pretty close together. Calculations shouldn't be that hard. You are basically, we're able to get the present worth of both of the fixed costs. Now you're putting on an annualized basis, and the cost to operate was already on an annual basis. You know, how much you're spending per year to operate the motors. That's it. Now, where do these get complex? Well, in this case, it's relatively simple, because there were only two costs here that we had to look at. The cost of operating the motor and the initial upfront cost of the motors themselves. So those two. Now, most things are going to have some more costs associated with the operation, maybe some more costs that you have to bring back to present worth and then annualize. Again, don't panic on these things. They're relatively straightforward in the common sense. If something's an annual cost, like the cost to operate the engine of the, so this is the motor, you just simply add it to the annualized cost of the equipment itself. That's it. It's that easy. Now, here's another one that's kind of interesting. What if you have alternatives that have different project lives? Well, here's where the annualized really becomes valuable, because annualized equivalents don't care how long something lasts. They're broken down into an annual basis. So in this case, we're looking at a Model A and a Model B. We can look at it over one cycle for Model A and Model B. Now notice, Model A lasts for 3 years, Model B lasts for 4 years. Okay, and it's got costs given on those bases. How do we compare the two? Well, on annualized, it's the same basis when you annualize these costs. So an annualized equivalent will work very well. So we can work out annualized cost of Model A. There it is. There's the calculations. Okay, see that P over F and that A over P? Those are something that I expect you to be able to do. Now, of course, you can always get the tables and look them up. And if you have the book, the tables in the back of the book, but I gave you a spreadsheet that allows you to actually generate those tables if you want them, or just use a spreadsheet to calculate them. Okay, I gave you that too, by the way. Now, say it works through 4 replacement cycles. Notice that the present worth for 4 replacement cycles is different, but the annualized cost comes out the same. Okay, that's the concept of the annualized cost. Now, I'm not going through the calculations here. You've got them on the screen. You can do them yourself if you want to work through it. The numbers are there. You can see them. Notice Model B, okay, the one that lasts for 4 years, has an annualized equivalent, -12. That's a cost. A, -1035, 10,352. What does that tell you? Okay, B's costing you more than A. Now, you put them all, so even though the lifespan of A is less than B, okay, it's 3-year versus a 4-year, it still costs less. That's the beauty of the annualized equivalent. I'll review this one more time. We could take this to PW, but present worth, but annualized equivalents, especially when you've got operating costs associated with these things, is the way to go. Also, it's the way that you report how much you're going to make per year. That is important. Present worth is still very useful for looking at different alternatives and actually doing a comparative analysis of different alternatives. Annualized equivalence is typically the way you're going to go. You have to know PW though. Why? Because you calculate the PW to get the annualized equivalent from it. Then you look at those annual operating costs and also annual revenues. And those can now be added directly in. That's the beauty of this. So here you go. What do we cover? This is it. This is the 2 biggies. Annualized equivalent worth, okay, which is essentially the present worth, then put into an annual basis. Should give you the same decision as present worth, but your boss is going to like it more. They like it on, hey, what's this going to cost per year? Okay, the capital recovery, we looked at that one. That was the, oh, what happens if I buy a car and sell a car? Well, guess what? That is the way you do this. There's your CR equation, initial cost and salvage value. Oops, and I don't think you can see this. I will read it to you. It's off the screen, but you do financial reports. Financial reports are typically done on an annual basis, and that's the way you want to report it. You calculate unit costs when you make things or sell things. AE is the way to go when you're dealing with that because you're going to do that on an annual basis. Cost of use, very good. AE works very well. Or when you're looking at a make or buy decision, especially, and that was the one we just showed you that one as an example. Also, you have different periods of time of 2 different alternatives, okay, it works really, really well because annualized doesn't care what the period of time is. It's an annualized equivalent. All right, I'm hoping that you guys get this. I know we're getting into some stuff that is like it's really, really getting confusing, but it's not. You get down what the costs are. You get down what the revenues are. You take some, like if you're making money on a per unit basis on an annually, don't necessarily have to worry about getting that down to a present worth. But the ones where you've actually got some values there that are on your cost timeline, present worth, annualize. It's that simple. Okay. Don't overdo it. Don't overthink it. And of course, if you got questions, I'm always here. On out.